Hi there, I'm Champion Trader Kevin Davey, and today I'm going to reveal an algo trading strategy for hard red winter wheat. And I think you're going to like the way it looks out of sample. So let's get started. So today I'm going to look at a strategy for hard red winter wheat futures. Now, this isn't one of your more common markets, but it's still a good one if you want to be diversified. If you want more information, you can go to the link right there from the CME group, and it will tell you all you need to know about hard red winter wheat. It's not the same as normal wheat, and you can see that by the symbol. In Tradestation, it's KW. Some different vendors have different symbols, so you might want to check with your particular data vendor. And the way it's set up, it's $50 a point for the futures, and it has about a $31,000 notional value at the time I'm making this video. And like I said, there's wheat, there's hard red winter wheat, and then there's a couple other types of wheat. Normal wheat, just W, is the biggest one, and hard red winter wheat is that dark blue that you can see right there. So percentage-wise of the market, it's a significant portion, but it's not as big as the overall wheat market. But there can be a lot of advantages to trading it. It does act differently at times than the normal wheat market. Okay, so here's how I set up my chart before I do all my testing. It's at KW, which is the back-adjusted continuous futures contract. I'm using 360-minute bars here, which is a 6-hour bar. And that's pretty much it for the chart setup. Now, let's take a look at some trades. I'll show you the code in a minute, but first I wanted to show you visually what these trades look like. So first, here's our signal bar. So everything to the right hasn't happened yet at the time that the signal's taken. So first, there's a 200 bar downtrend. And you can't really tell from this chart that it's there because I don't show 200 bars back. But it's there, and that's part of the criteria. Then the second criteria is when the closing price crosses above a fast moving average. So here, the fast moving average is actually in blue, that light blue, and you can see on the signal bar, the close closes above it. So it crosses from below to above the fast moving average. So that's part of our criteria. And then the third piece of the criteria is that the close is less than a slower moving average. And the slow moving average is in purple there. So you have three things to make a trade. You have a 200 bar downtrend, you have a close crossing above a fast moving average, and you have a close that's below or less than a slow moving average. Those three things have to happen, and then the next bar at the open, you buy. And you can see that it does it right here. For short trades, it's exactly the opposite. So short trades would be a 200 bar uptrend. It would be a close crossing below the fast moving average, and it would be a close that was greater than the slow moving average. So it's a symmetrical type situation. So that's a sample trade. Now, let's take a look at the code. This is Tradestation code for the language they use, Tradestation Easy language. And I'll go through it. I think you'll see it's pretty easy. That's why they call it easy language. But you can pretty much read and follow along with me. So I have two inputs. I have the fast length, the fast moving average length, and I also have an exit break-even floor amount. And I'll explain that in a second. But the long entry, again, the close is less than the close 200 bars ago, So you're in a longer term downtrend, and the close crosses above the fast close, average close, and the close is below the average of a slower length. In this case, I'm multiplying the fast length by 2. So if the fast length was a period of 10, then the slower length here would be 20. Okay? And if all three of those things happen, you buy the next bar at market. That also means if you're in a short trade, you exit any short trade first and then go long. You can see the short entry is exactly opposite. Instead of less than, we have greater than. Instead of close above, we have close below. And instead of less than an average, we have greater than an average. And then we sell short. So that's our short entry. Then for exits, in this particular strategy, I'm only looking at the break-even stop. I'm not looking at a stop loss or profit target. So the way you can exit a trade is either by reversing from long to short or short to long, or by using this break-even. Now Tradestation has a break-even keyword. I've included it, commented out in green, and it says set break-even, and you put a floor amount, meaning once the max position profit goes above that amount, that will trigger a break-even stop if the price falls back to that level. I didn't use that in this case. I used one that will use the next bar and it will exit at the market. I tend to like that a little bit better. But what it says here is if the max position profit is greater than that floor amount, and at the close of the bar, if the open position profit is less than $100 per contract, meaning it's close to break even, then you sell or buy to cover to exit either your long or your short. So that's the exit. It's a break even. It's a pseudo break even because it doesn't exactly get you out at break even, because it waits till the next bar, and it also has that $100 open position profit, but as it gets close to zero, it will exit. Okay, so let's look. I did some optimization. You remember I had two variables that I was optimizing, or inputs as they're called in Tradestation. One was the break-even length, or break-even amount, I should say, and the other was the moving average length. So there's the optimization results. It's a little hard to see, but I ran 44 different cases, so combinations of different lengths and breakout amounts. All of them were profitable, which is nice. And like I said, I used the moving average length and the break-even threshold as the variables I was optimizing. And the case I've selected just to show you was definitely not the best case. I don't like picking the best case ever. This was actually the 18th best case that you can see right there as far as net profit goes. So it was a good one, but not the best. And the other thing that's interesting too is that all of them, all 44, do produce profit. And that helps when you want to establish some kind of robustness. You're not relying on one particular combination of parameters to be profitable. There's a wide range that are profitable. So let's take a look at the equity curve, and you can see the curve in white is the development phase, and that's what I would have optimized over to get the parameters I ended up using. And then the blue, which I showed you at the beginning of the video, is since this system has been live, which was the beginning of 2022. So you can see there's quite a few trades that have happened after the system was developed. And that, of course, is always the best sign that a strategy is going to perform well in the future, is that it performed well after it was built. Here's a performance summary. Interesting thing here is you can see the short trades make a lot more profit than the long trades. A lot of strategies I like to have them about even, but some markets just favor the long side or the short side. But the strategy does make money going long and going short, and it takes roughly the same number of trades going long and short. One interesting thing digging through that I thought I'd bring up is if you look at the average profit by month, you'll see that September through December, it loses money. Now, a lot of people are probably saying, well, hey, I should just eliminate that and those months and not trade that strategy during those 4 months of the year. Well, I can tell you, I talk about it in my workshop, that is a dangerous thing to do. Now, if you had decided on this beforehand and you said, oh, because of red winter wheat and the way it's planted and the crop cycle, if I want to be good about this, I'm not going to have it trade from fall through the end of the year. If you had said that before you ran the test, that would probably be okay because you'd have a reason for doing what you did. But to look at the results and then make a decision, that's a big no-no. And it's something I talk about in my process, my strategy factory process. And one of the things I also do in that process is I do walk-forward testing. And you can see the equity curve for a walk-forward version of this strategy. So it's a little more complicated. I only showed you the simplified version of the strategy. But it's something you definitely want to do to help keep your strategies working as well into the future as you can. It's called walk-forward testing. And again, it's something that I talk about in my workshop. I also discuss things like why you shouldn't eliminate those losing months. If you want more details, you can go to my website, click up at the top for workshop, and get all the information you need. So, if you have questions, please leave a comment, hit the like button, hit the subscribe button, or send me an email at the email address listed. Thanks for watching. I hope you enjoyed this strategy.